Randy joins me here today, and you could learn what his team is up to. And you got two websites you can find out more information: invest arc.com or multifamilymaestros.com. Randy, I really appreciate your time here today.
Well, Jack, it's a pleasure to be on the show today. Thanks so much for the invitation. I look forward to providing some value to your listening audience and the introduction of myself.
Yeah, we kind of were chatting a little bit before we hit record, and I wanted to spend a little time about how you found your way into real estate investing and then into multifamily, because you were in the corporate world for quite a while. And I think there's a lot of people who listen to the show find themselves in a similar situation. So let's explore that a little bit, the mindset shift and everything that happened there.
Well, happy to do so because it's really who I am. Like a lot of people of my genre, I'll say, I was raised with a mindset, father coming out of WW2, get a good education, join a big company, climb the ladder as best you can, and retire after a long career and live a nice life. And that was kind of the paradigm I grew up with. It works for a lot of people. And so it really started for me in real estate around the Great Recession around 2009-ish, 10-ish, when I saw half of my net worth vanish in about 45 days, 30 to 45 days in the stock market, 401ks and all that stuff. And I was working for a private equity company at the time in Cleveland, Ohio. I now live in Houston, Texas. And it was just an aha moment for me. I'd been an exec making a good dollar, so I kinda had a bullseye in my back, and I thought I was gonna be laid off, not because of any performance issues I did, but just because of the economics and headcount reductions, and it was just a truly an aha moment that you need to do something different, big guy. And so I really started looking at all kinds of opportunities from buying a small business. At the time, I said I was living in the Cleveland, Ohio market, looking at franchises to buy franchises, and I ended up getting involved into real estate. My initial entree was a brother-in-law a brother-in-law and I became hard money lenders to a group in South Florida while I was still working. We were lending them the money to flip houses and taking a nice return. And so that was my first entree into it. And then I moved to Houston, Texas from Cleveland, Ohio for job opportunities in about 2013. I found multifamily by attending a networking conference. I found one of the big think tanks called Lifestyles Unlimited here in Houston. I went to several of their meetings and heard a guy speak by the name of Brad Sumrock about multifamily. Again, this is 10 years ago in 2000 and late 13, early 14. And that was my second aha moment when I realized, I was putting all this money at risk doing flipping houses. But when you're buying a multifamily loan, at least that one that's Fannie Mae or Freddie Mac backed, it's a non-recourse loan. I've been looking at buying businesses and having to put up personal guarantees, but I could buy a multi-million dollar apartment building on the value of the asset and not jeopardize any of my savings or anything that I had accumulated thus far in life. So long-winded introduction, but that's how I got started.
But you mentioned that in your corporate world, you feel like you're in a much better place right now. Is that just your mindset of that? You feel more comfortable with this, or you just enjoy it more?
So I have always had an entrepreneurial itch. I am a father of four children, a single income family. So I always felt very much wanting to hold my husbandly and fatherly duty to provide for my family. So I had to have an income. Early in my career, I really didn't want to step away and go from whatever to nothing in income wise. And as I climbed that corporate ladder and was in an okay position, I was making a pretty good buck. And so I decided to do both. I was going to work a lot. I'd work my day job and then nights, weekends, work the real estate thing to grow that. And that's really the way I did it for the first 9 years or so until I left the corporate world last year. But more specifically around mindset, yeah, I feel much better about what I'm doing. I say I'm working for myself. I still work a lot. That's my personality. There's a lot to do, but I'm doing it for myself versus the man. and I don't have to fill out all these, forgive me, worthless corporate reports called budgets and performance evaluations and monthly reports, et cetera, that I know nobody was reading. Uh, and so, yes, I feel much more fulfilled today than I did after a long and I'll say prosperous career in the corporate world. I feel it's for me personally, it's much more gratifying.
You mentioned that you feel some freedom when you went to multifamily. You're not putting your money so much at risk. Could you talk a little bit more about that? I think a lot of people assume that, especially small investors getting into this, that they are going to have to put up some capital and their personal liability.
Yeah, that's, I used to drive around and you'd see that big apartment building that looks gorgeous and you say, man, that person must be filthy rich who owns that. And then when I learned the power of syndication, you know, other people's money combining your worth and other people's money into a syndication to buy a large multifamily asset, it just became the only way to go for me. So if you were to default on that loan, the lender could come against you and theoretically take your cars, any other assets you had accumulated to pay off that loan. In a non-recourse loan, the lender you can lose your money. The lender can take the equity that you have in that building, but they cannot come against you personally. That's a huge differentiation, huge for the investor getting in. Now, if you're going to buy a 4 unit or a 5 unit, I think the definition of multifamily is anything 5 units or greater from a commercial lending perspective. And then if it's most likely going to be non-recourse, unless you go to a small regional bank, there may be some limitations. But the gold standard of lending is the Fannie Mae, Freddie Mac loans that are non-recourse. And I learned that I could buy again a multi-million dollar asset with combining my money with other people's money in what's called a syndication and the power of leverage to do that. It's something that a lot of people should think about, either as a passive investor or as a general partner or what's called an active investor.
Well, let's go down that road. Invest-arc.com is where they can maybe get involved passively regarding some of your projects.
Yeah, so if the listeners want to go out there and just look at kind of the portfolio we have, but yes, you can see kind of the approach and if you find me on LinkedIn, Randy Langenderfer, I've got a free webinar out there that explains a whole lot more a whole lot more of the process of being a passive investor. But very simply, being a passive investor or an active investor, the illustration I always use, and you probably heard, is the airline. The pilot in the front of the plane is considered the general partner or the active partner. And he's got to watch out for air traffic control, the weather, the mechanicals, et cetera. He's very involved and active, he or she. The passive investor is the person like me sitting in the back of the plane, sipping their favorite beverage and reading their favorite book and enjoying the ride. So which one do you want to be? Most people want to start out at least being a passive investor. And that's a great way to be, where you don't have to worry about tenants, toilets, and termites. All you do is talk to people like me, the syndicator or the active partner, ask questions, gain comfort, and review the deal and see if you like it. And that's basically the power of syndication. You as an individual with 50 or whatever $100,000 you may have to invest, nor could I. But together we can. And that's the cool part. It's the power of leverage and the power of the syndication.
Can you talk a little bit? Do you work strictly with accredited investors? Anybody can get involved? How does that look?
So for your listening audience, there's another term we just use: accredited investor versus sophisticated investor. Accredited investor is someone who has till the government decides to change the definition. Right now, I think it's a $1 million net worth, excluding their primary residence, or $300,000 joint income a year is the definition of an accredited investor. A sophisticated investor is just everybody else, assuming you can read a financial statement and read a private placement offering. But so I've done both, is the short answer to your question. I've done both. Accredited investors only, purchases or acquisitions with accredited investors only. And other ones I've done can do either sophisticated or accredited. So that's the 506B offering. It's the regulation, not to get into too much detail, Harold, but that's the regulation D of the IRS code, section 506B as in boy, says that you can only have up to like 35 sophisticated investors, and a 506C as in Charlie offering says you can have unlimited number of accredited investors. So what I've done, Jack, is I have partnered with other people because again, I've learned the power of not only syndication, but partnerships, partnering with people. So I own today in Tucson, Arizona, Houston, Texas, Dallas, Texas, and I invest passively. I'm a passive investor too in other people's deals. And so I'm pretty much all into this asset class. I've probably got 35% of my net worth in various syndications around the country just because I believe in the asset class and the model and it can be very profitable. So investors need to decide, are you okay with generally investing in a single asset or do you want to buy it? Just talking to an investor yesterday. He didn't like the idea of buying into a single asset, a single apartment building that we're buying versus a fund that has multiple apartment buildings in it. So either one is fine. Again, the investor just has to decide. I would say that I think the advantage of a single asset in a private placement offering is you get a K1 and or a favorable tax treatment and positive cash flow as well. And that K1 you don't generally get in a fund if you get in a real estate investment fund.
Well, we'd like to hear about this project you're currently working on. You said you're looking at another building at the moment?
We are actually doing a build to rent offering. And if your audience doesn't know, a build to rent is kind of the latest rage in real estate. It's where rather than building apartment buildings, we're basically building townhomes, standalone townhomes to rent. So these are going to be 1,700 square foot, 3 bedroom, 2 baths, garage, patio townhomes. And they're built to rent, just that. They are, targeted for young families or boomers like myself that want to get out. So it's in northern Dallas. We're real excited about that. And so that's a development project that's underway. And we're really excited about that because there's a lot of population that doesn't want to live in a 3-story apartment building. Townhome gives them much more the feeling and comfort of a home versus an apartment building. And so it just depends. They tend to be a little bit more pricey in rent, but you get a lot more of your own individual and owned individual space and townhome feeling. So that one is almost completed, probably at the end of the year, November, December, completed the horizontal, putting in the streets and the roads and all that stuff in Melissa, Texas, north of Dallas. And then we're going to start building it in January of 25. And so if any of your audience has any interest in that, you can reach out to me.
Yeah, again, it's invest-arc.com, or you can go to Multifamily Maestros for some more information on how you can get a little training there. If you found some value in what we're talking about so far, do us a quick favor and share this with one of your investor friends. And if you're watching us online, do us a quick favor and like and subscribe to this channel. So, Randy, a lot of people who are thinking about doing this type of thing, the concept of passive investing sounds great. They got to select a syndicator. What are some of the questions they should be asking to make sure it's a good fit?
Yeah. So I have that Multifamily Maestros is actually a mentoring slash coaching program. We cover this extensively in that program, but it's a great question, Jack. If you're new to this space and you're thinking, I'd like to diversify my portfolio, I got a whole argument as to why everybody should have some commercial real estate in their portfolio. Really, you need to start thinking about first and foremost important thing is the general partnership or the syndicators. Who's putting the deal together? What's their experience? And do you trust them? This is not regulated by the SEC or anybody like that. It is a business. Sometimes bad things happen, but so who is the sponsor? What is their track record? And you need to spend some time getting to know them a little bit. And if the sponsor isn't willing to spend some time, either meet you for coffee or Zoom calls or something, let that be a red flag to you. I spend a lot of time on the conference calls and coffees just to meet people. And we don't even talk about real estate all the time because I want to know them as well and understand their investment criteria. I've recommended several times people not invest after talking to them. I don't think it's appropriate to put your last $50,000 or something like that into an asset. This should be money that you're looking to grow. In the very worst case, could afford to live without. But passive investing is not something you're going to get from your financial advisor. I'm a CPA and an MBA in finance, and I didn't get this till later in life myself, and I consider myself fairly educated. But you don't hear about it, and that's that all the big names, the Trumps, like him or not, and others, even Warren Buffett has gotten into many different syndications, private placement offerings such as these. They happen all the time. You can find them in oil and gas is very prominent. Just about anything today is syndicated where, large sums of money are needed. So you just have to decide the sponsor. That's the first big one. And then the second one is look at the asset. So you need to develop your own investment criteria. I tell people what they say, what do you do? I say, I invest in the Sun Belt. That means the southern half of the United States. So right there, if somebody sends me an opportunity in Toledo, Ohio, and I know that very market very well, no thanks. I don't invest in that area. So,
Mhm.
and then, somebody, I want to do a 20-unit apartment building in Indianapolis. Good luck. I'd love to help if I can, but I'm not your guy. So develop your own criteria. Number one is the sponsor. Number two is where the asset is, what size it is, how old it is, what shape it's in. And the other one today I would really put on there is three is debt. What kind of debt is the sponsorship group putting on it? Does the debt match their business plan? So by the debt, we mean every one of these has a bank loan on them, a lender of some type. They're the biggest customer. They're going to pay anywhere between 65 and 80% of the purchase price. And you want to make sure that that repayment matches the business plan. So if they tell you they're going to get out in 5 years, but they got a 10-year term note on it, why is that? Or God forbid today, it was popular a couple of years ago, but you don't want to invest in anybody that's doing variable rate debt right now. That may change, but right now, as I record this in September of 24, uh, that's very much out. So I would put those in the top three. I would put the sponsorship group, the market, the debt, and I think out on my website, there's some blogs that talk about many more.
You briefly touched on this, but I'd be curious as to what you think of the economy, where it's going, and what type of shakeup have you seen in the market over the past few years?
That's a really good question, Jack. As I've said, I don't know. There's a much to be said. It's almost inevitable that the market has at least priced in a rate reduction here probably next week as we record this again with the Fed lowering interest rates. I think the only question is how fast do they come down and can they avoid a major recession? It seems like the Fed is now focused more on job losses versus inflation, which I think is the right direction. But if we hit a recession, and it's just depending on how severe, how deep it is, that's going to have a lot of ramifications on investing. People tend to tighten up and not want to spend spendable income on investments like multifamily or other assets. But that's really when I would argue that right now, and for the next probably 12 to 18 months is going to be a wonderful time to buy investment properties because of the declining interest rates. And what is it Warren Buffett says when other are fearless, you should be aggressive or something like that. So I don't know how the economy is going to go. You can argue it either way. But the reality is, I was talking to another investor, I don't feel comfortable buying right now. And I said, well, you own 401ks and stocks through your employer. When the market's down, do you just get out of that altogether? No, generally not anyhow. You continue to invest, and so I tend to be I like the theory, and I would tend to call myself, I'm a buyer at any place in the market. It's just that you buy very differently and down cycles and up cycles and, you know, interest rate cycles. You buy very differently, but there are opportunities out there for the savvy investor that I think in the next 12 months are going to turn some very nice returns.
How has your buy box changed over the past few years? Did you now you're even doing some building, so I would imagine that you're sharpening that pencil on a pretty consistent basis as prices are fluctuating.
Yeah, and so the build is I'll put that as kind of on the right side for now, but the rest of the portfolio is pretty healthy. We have several properties that we purchased in 21, 22 on variable rate debt. That is a challenge right now as they become up for rate cap renewals and stuff, but we're optimistic and think we're going to weather the storm. On the buy side, existing properties, I would not do anything today on variable rate, as I said previously, even though some say that's the time to go variables because rates are coming down and you could get some sweetheart deals as the rates come down. I just tend to be more conservative on the build side and the build to rent side. That is, we conservatively underwrote that one, Jack, by we raised a bunch of money in the fourth quarter of 23. We used all that equity to do the horizontal construction. There's not all of it, much of it, say 40%, to do the horizontal construction, the streets, the utilities, et cetera. So that gave us a whole better place to go out and negotiate rates now with the lender for it will be variable rate, but only a year or two for the horizontal build until we get it built. But that gives us a whole risk mitigation strategy there of using the equity we raise to do the horizontal construction. And then it puts us in a very favorable place right now. We've gotten some very favorable terms on debt for the vertical construction. And so we're looking forward to that.
Well, Randy, this has been a fantastic conversation so far. And again, if you would like to learn a little bit more about how you can either work with Randy or get a little coaching, head over to invest-arc.com or multifamilymaestros.com. Randy, can I ask why did you decide to offer some coaching?
Well, so I got into this late in life and I mentioned a couple of what I refer to as the big box educational arms, the lifestyles, the Brad Sumrocks, and I've even been in Rod Khleif's masterminds. Enjoy them all. That I have nothing disparaging to say about any of them. But what I found is there's a segment out there that really wants a smaller, closer knit community, more intimate, and being able to get on calls like this and ask questions one on one versus, one on 100 or even others areas. So it's my partner's attempt to try and give back and help propel other people's growth. Many people build into my real estate journey along the way, and we really want to do that. And so we're trying to provide what I call the opposite of the big box, which I call it the Home Depot versus the True Value Hardware. Home Depot is the behemoth, the big box. But I walked into my local True Value Hardware a couple months ago, and somebody met me at the door and said, "How can I help you, Randy?" He didn't say, "Randy, how can I help you, sir?" Just a very customized approach, personal approach. So we offer online training. We have about 13 different modules that contain over 35 plus short videos on everything from talking to brokers to underwriting to developing a buy box, all those key elements. And then we have group calls once a week and on one-on-one as needed. I don't want to have any more than probably 10 students personally. Um, that'd probably be the max. So we're trying to develop a much more intimate setting is the short answer why we got into it and giving back. And
Sure.
it helps everybody.
Well, Randy, before we jump into, and I don't think I warned you at the beginning of the show, my rapid fire questions.
Uh-oh.
Is there a question or concept you think we should have tried to cover here so far today?
I'm good, but I really now you got me concerned here a little bit, but that's all right, Jack. All right. We'll win.
I think I should spring it on people more often. We were chatting a little bit before we hit record, and I usually remind people of these. but I'm sure you're going to be fine.
Sounds good.
So,
Let's do it.
the number one question is, what lie do real estate investors sometimes tell themselves?
What lie do real estate investors sometimes tell themselves? That it's no work. I think it's a lot of work. I remember the first mentor I had, I won't mention his name, but he said, the less I do, the more I make. That may be true because he was at the pinnacle of his career and he had a whole team underneath him. So he didn't have to do a lot. Getting started, getting that first acquisition or feeling comfortable to write that first $50,000 check for an investment, it should be taken very seriously.
If you could go back in time and give your younger self one piece of advice, what would that be?
Just do it. I don't regret anything I did, educated myself in the corporate career and all that stuff. I enjoyed it immeasurably and it provided for my family, but I would have been entrepreneurial much sooner. I would have probably started over to buy rent houses and started smaller like that and started leveraging up. So as Rod Khleif says, take massive action. You got to get by the thinking stage and do something, whether it be
Sure.
multifamily, single family, or elsewhere.
Do you have a book recommendation?
I got a bunch of book question recommendations back there in my nothing. Not all of them are real estate. Oh, you can't see them. I took them out of the picture, but there's one there that I really like. I've been reading called by John Mark Comer, "The Ruthless Elimination of Hurry." The ruthless elimination of hurry. As we are all in a society of nothing to do real estate. Real estate wise, you've got the traditional ones, Think and Grow Rich, etc. The Hands Off Investor by Brian. For the passive investor, The Hands Off Investor by Brian Burke. That's a great one if you're thinking about passive investing and getting in. It takes for the uh, person who wants to know the details and understand what they're really doing, which I encourage and help you do that. That's a great book.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
I don't know, it's a single action, but I would say the mindset change was I don't have to do this all myself and having partners to propel my growth. So I think I take that as a strategy from working in the corporate world, the ability to develop teams. And so partnering with people in those different markets, as I said, Houston, Tucson, Dallas, to propel acquisitions and growth have been something anybody can do. It just takes time.
Well, Randy, this was a fantastic conversation. Really appreciate the value you brought to the show. Again, it is invest-arc.com or multifamilymaestros.com if you're looking for a little coaching around this. But really appreciate your time.
Jack, thanks again. I'd love to talk to anybody in your audience. If you got anything else you want to chat about, there's contact pages on both of those and would love to schedule a quick call and get acquainted.